What if the biggest move in XRP's history wasn't a price pump, wasn't a court ruling, and wasn't even a headline? What if it was happening in the background quietly, methodically, deal by deal, and the people who miss it are going to look back in 5 years completely stunned? Here's the thing that nobody is connecting right now. While the XRP community is arguing about whether Ripple is bullish or bearish on price, Ripple is doing something that virtually no other crypto company on earth has the infrastructure, the licenses, or the institutional relationships to actually pull off. And once you see it, you cannot unsee it. I'm Marcus Webb, and on this channel we talk about what's actually happening in financial markets, not the noise, but the signal. If this is your first time here, stick around because today we are going deep on something that I genuinely believe most XRP holders do not fully understand yet. And that gap in understanding is either going to cost you or reward you enormously depending on which side of it you land on. Let me paint you a picture. Imagine you're a chess player, and you're watching someone across the board make a series of moves that look unrelated. They move a bishop, they develop a knight, they castle. Early, the crowd watching thinks nothing is happening. The game looks slow, boring even, but experienced chess players in the room recognize those moves immediately. That's not randomness, that's a prepared opening. Every single piece is being positioned for an endgame that's already been decided. That is exactly what I see when I look at what Ripple has been building over the last 18 months. Now, a lot of people got caught up recently on whether Ripple was doing a buyback. There was speculation, there was hype, there was disappointment when the announcement didn't match expectations. But I think the entire conversation missed the forest for the trees, because a buyback would have been small thinking. What Ripple actually described, moving XRP deliberately into the hands of the world's largest financial institutions, is an entirely different scale of strategy, and it's one that almost nobody in the retail crypto space is trained to recognize because it doesn't come from crypto. It comes from traditional capital markets. So, let me explain it using a world most people actually understand. Think about what happened with U.S. Treasury bonds after World War II. The U.S. government didn't just dump war bonds on the open market and hope for the best. They ran deliberate campaigns to place those bonds with banks, pension funds, insurance companies, and foreign central banks institutions that had long-term reasons to hold them and no short-term reason to sell. The result? A stable, deep institutional holder base that gave the US dollar its global reserve status for the next 80 years. Now, nobody is saying XRP is a reserve currency, but the architecture of that strategy, deliberately seeding an asset with the right long-term institutional holders before the asset scales to its full function, is the same architecture Ripple is describing. Here is why this matters more than any price chart. When an asset like XRP is held primarily by retail traders, people on exchanges, short-term speculators, day traders, it is fundamentally fragile. The holder base is emotionally reactive, it moves with headlines, it panics. That kind of fragility is incompatible with an asset being used to settle real transactions between financial institutions at scale. Banks don't want to use a settlement layer whose underlying asset can drop 30% in a week because a tweet went viral. But when an asset is held by institutions with operational reasons to hold it because they need it to settle cross-border transactions, because it's on their balance sheet as a functional tool, not a speculative bet, the dynamics change completely. You get a stable, deep, liquid institutional market. That is what enables the asset to do serious financial work. So Ripple isn't distributing XRP because they want to dump, they're distributing XRP because an idle asset locked in escrow does exactly nothing for the network it's supposed to power. Now let's look at the actual infrastructure that's been assembled, because this is where it gets genuinely interesting. Ripple secured a federal banking charter from the OCC, that's the Office of the Comptroller of the Currency, the same body that regulates JP Morgan, Bank of America, Wells Fargo. That license isn't symbolic. It means Ripple can now interface directly with the US banking system in ways that most fintech companies and virtually all crypto companies cannot. Then there's the Hidden Road acquisition. Hidden Road is a prime brokerage, a company that provides services specifically to institutional investors, hedge funds, asset managers, large trading desks. Ripple buying a prime broker is not a retail play. Prime brokerages don't serve you and me, they serve the clients who move billions. Then consider the Ripple stablecoin crossing $1 billion in market cap. That's not a vanity metric. Stablecoins at that level become viable as actual transaction rails, and Ripple running natively on the XRP ledger creates a reason for any institution using Ripple to also have exposure to XRP infrastructure. And Goldman Sachs, one of the most conservative, brand-conscious financial institutions on earth, disclosed a position across multiple XRP investment vehicles. Goldman doesn't take public positions in assets they don't intend to be associated with for years. Their compliance and reputational risk departments would not allow it otherwise. Each of these moves is a chess piece. Each one alone is interesting. Together, they describe a board that is being deliberately set. Now, I want to be honest with you because I think that's more valuable than cheerleading. The legitimate concern people have is simple. If Ripple is moving supply out of escrow and into the market even strategically, doesn't that create selling pressure? And the answer is, it depends entirely on who's on the receiving end and why. If supply moves from Ripple's escrow into the hands of an institution that immediately sells it for dollars, yes, that's net new supply hitting the market, that's bearish in the short term. But if supply moves from Ripple's escrow to, say, a global bank that holds it as a functional reserve for cross-border settlement, that supply is effectively removed from liquid circulation. It's not going back on an exchange. It's sitting on a corporate balance sheet as an operational asset that is structurally tighter supply, not looser. The critical question, the one we don't have perfect visibility into yet, is the composition of these institutional placements. Are the recipients strategic holders or short-term arbitrageurs? The answer to that question is probably worth more than any technical analysis you could do on ZIRP's price chart. What we do know from public disclosures is that the types of institutions Ripple is engaging: prime brokers, federally chartered banks, ETF issuers, are not in the business of flipping crypto positions for quick gains. Their fiduciary responsibilities and holding structures make that almost impossible. Here's something I want you to sit with for a minute. We are at a moment in financial history that genuinely does not have a clean precedent. For the first time ever, a digital asset designed specifically for institutional settlement is being systematically distributed to the institutions that were always supposed to use it, while a regulatory framework is actively being built around it in real time, while major Wall Street names are publicly disclosing positions in it. None of those three things had ever happened simultaneously for any digital asset before. Bitcoin's story is digital gold. Ethereum's story is programmable money. ZIRP's story, if it plays out the way the evidence is pointing, is something different. It's the story of a settlement layer that spent a decade waiting for the institutional infrastructure to catch up to what the technology was already capable of doing. And if that story completes, if XRP ends up on the balance sheets of the institutions doing global settlement, backed by licensed infrastructure, inside ETF products, with regulatory clarity, then the price you see today is not the price this asset trades at when that system is fully operational, not even close. Now, I'm not giving you a price target. I'm not telling you to buy or sell anything. What I am telling you is that the architecture being built around this asset is not the architecture of a casino. It is the architecture of something that was designed to last. So what do you actually do with all of this? The first thing is to stop measuring this in weekly candles. The strategy Ripple described is a multi-year distribution into multi-year institutional holders. Trying to trade that on a 4-hour chart is like trying to watch a glacier move by checking it every 5 minutes. The second thing is to think seriously about where your XRP lives. There is a meaningful difference between XRP sitting on a centralized exchange subject to exchange risk, counterparty risk, and the temptation to panic sell an XRP in a structure designed for long-term holding. One of the structures I personally use for a portion of my holdings is a self-directed Roth IRA through interest capital. The reason is straightforward. Any appreciation inside a Roth IRA is permanently tax-free, not deferred-free. You pay no capital gains when you sell inside the account. You pay no income tax on qualified distributions in retirement. For an asset you believe has a multi-year, multi-decade runway, the tax math on that is significant. Interest Capital holds actual native XRP, not a derivative, not a futures product, and they also support Erlust, HBAR, XELM, Quant, XC, Flare, and a number of others, plus physical gold and silver. They're adding equities and ETFs this summer, which makes it genuinely compelling as a single long-term account. There's a link in the description and a $100 bonus when you fund your account. The third thing, and I say this because I've seen how much confusion costs people, is to have an actual written plan. Know your entry thesis. Know your exit conditions. Know your tax exposure at different price levels. The people who get crushed in volatile assets aren't usually wrong about the asset, they're wrong about their own behavior under pressure. A plan doesn't prevent volatility. It prevents you from making emotional decisions when volatility hits. Here's the bottom line. The conversation about whether Ripple did or didn't announce a buyback is the wrong conversation. The right conversation is, what does it mean if the largest financial institutions on Earth are being deliberately seeded with XRP as an operational asset over the next decade? That's not a crypto question. That's a financial infrastructure question. And the answer, if the pieces continue to fall into place the way they have been, has implications that go well beyond anything most people in this space are currently pricing in. Watch the moves, connect the pieces, and build a plan that doesn't require you to react to every headline. Drop in the comments what piece of this story do you think is the most underrated right now. I read every one. If this added something real to your thinking, hit like, subscribe, and I'll see you in the next one. Stay sharp.